A wedge is a charting pattern that is similar to the symmetrical triangle in that it contains two slanted trend lines which tighten towards a final apex. The difference is that a wedge will have both trend lines moving in the same direction, with two descending trend lines forming a falling wedge, while two ascending trend lines will form a rising wedge. Typically, wedges are counter-trend patterns, much like a flag, and that means that a rising wedge is deemed to be bearish, while a falling wedge is expected to break out towards the upside. Of course, you can also see wedges that are moving with the trend rather than counter-trend, yet the key is to remember that a rising wedge is bearish, while a falling wedge is bullish. Let's look at an example of both a rising and falling wedge in action, with Euro Sterling exhibiting both within 2015. The falling wedge seen throughout May to July period ultimately broke higher, rallying into a second wedge. This time the chart exhibited a rising wedge formation, which saw a sharp deterioration upon breaking lower from the pattern. In both these examples, the wedges are not counter-trend, yet as I mentioned earlier, this is not a prerequisite for the pattern, and instead the key is that the breakout will typically occur in the opposite direction of the pattern itself. I find that the best way to trade a wedge is to await the trendline break, and instead of trading that event, I wait for the price to close above or below the first swing high or swing low out of the pattern. If we look at the falling wedge in this example, we can see that actually the trendline break occurred around about 10 days prior to the close above the first swing high at 0.716. On this occasion, the daily candle closed on this level, yet I would be happy enough seeing a close above 0.716 on the 4-hour or even the 1-hour candle as a bullish confirmation. Now you know how to spot and use wedges. Make sure to keep checking IGTV for more education material alongside our usual analysis.